I always start off the show with a conversation, a summary of kind of what I saw happening this week in the stock market and the economy and et cetera. And actually, there's a lot going on this week. I
Hmm.
mean, the Federal Reserve met this week. We've got some of the more inflation numbers from PCE, the job report today, the job openings report. So there's a lot going on. So we'll talk about some of that, kind of how it affects that. So we'll start here just by looking at the overall chart. This is a weekly data. It just means that, the line is made up of weekly data points for where the market closed at the
Hmm.
end of each week. So we can look back farther. It looks back to 2019. We can see the pandemic drop and the big run that happened after that. And so obviously what we're looking at right now in the most current time frame was this kind of straight up line that started at the end of last October,
Yep.
which finally ended in in April last month, when basically the whole month was down for all
Hmm.
intents and purposes. But we are seeing a little click upward here, and what I want to do is kind of narrow this down, and let's take a look at hourly data.
Hmm.
Okay, so this is just the last 3 months.
Hmm.
So you can see it's a lot more jagged. It's not as smooth, but there's some pieces in here I want to point out that I think are really important, and some things that are happening right now that could be important. First of all, one of the things we talk about a lot when we're looking at the stock market is what we call primary direction.
Yep.
Okay, so comes from Charles Dow, right, the inventor of the Dow Index, the person that founded and started the Wall Street Journal, right? I mean, this goes back a long ways into the 1880s. And one of the things he talked about was, investing with the primary direction. And he wasn't looking at hourly data, really. They were looking at daily data and such.
Hmm.
But um, there's lots of different pieces that show what the primary direction is if you look at his writings.
Yep.
One of them, and I'll just point this one out because it's kind of simple. Most people can kind of grasp this pretty easily. It's just that you can tell the primary direction by the highs and the lows. And so, for example, when the market is going up, uh, and I put some arrows in here. Here you go. When the market is going up, the lows are higher,
Hmm.
right? And so you look at the lows when the market's going up, and you look at the highs when the market's going down. So in this case, you can see we've got what, 6 arrows of green. So kept coming back down, but never got to a new low. It
Yep.
always stopped before it got to the previous low, except for the red arrow that I put in there, right? So that's the first one. So theoretically, that is change of primary direction, and it actually was. It spent most of April there falling. And you can kind of see that. And so once you get into this primary direction down, all right, again, this is on an hourly basis. We don't trade hourly basis. Matter of fact, I generally look at primary direction on a weekly data basis,
Hmm.
but which makes it, much slower to make changes, but more so a buy and hold concept than a daily trading thing. But just this is a great way to make the point overall, because the patterns are fractal in the market, and so you can look at 1 second data, 1 minute data, 1 hour data,
Hmm.
one weekly data. You'll find the same patterns
Yeah.
all the
So
way
the
through.
principles apply throughout the different time
Yes,
frames.
yes. Uh, and so now if we look at the downturn, right? Okay, so now we're looking at the highs. So each one of those red arrows, the high attempted to get to a new high, didn't beat the one before. It kept coming down until we finally see that first green arrow there.
Hmm.
So that's the first one and that just happened in the last, few days here. And so now, if you look at it, we're in a new primary uptrend.
Hmm.
And so that's a big deal. What's important about this is just that when I was looking at the downturn that was happening this week, because we had pretty good sized downturn on Tuesday. I was wearing a red shirt on Tuesday, so it was 1.6%.
Hmm.
Down zero point 0.3 the next day, right? When on Wednesday, after Chairman Powell actually brought the market down, it was up during, before
Yep.
his Q&A. And I felt like the market was going to be establishing a new low here, and then continue back down, and quite likely get back down to 4,800. And I
Yeah.
talked about that during my daily videos. Just because that's kind of a normal thing. The market had stretched out quite a bit. You have, a huge run that happened for 5 months, and inflation was picking up in the first
Yeah.
quarter, and the Federal Reserve was waffling on, when they were going to do rate cuts. And we'll talk more about the Fed here in a minute. But um, but you got to pay attention to the market. If you just listen to the Fed, or you just listen to the news, or you just look at the economic data, you're going to miss out on what's going on because the information is in the market.
Hmm.
And so there's a reason that it's turning around. There's a reason that it didn't come back down to 4,800. And it might not, actually. This is a nice move here that it's making. And today is basically a green shirt day, right?
Yeah, even though we had those two massive down days, the week's pretty much a little bit up for the
Yeah,
overall week.
that's right. And so it's kind of a really important, support that it's found for itself. Now, usually when you have a 5% downturn, you end up with a 10% downturn, in my opinion, quite often, except when the market's really strong. And the time I remember this happening before was in 2021, and the market basically just kept going and going and going. And, we get these 5% downturns. I kept expecting more, and it wouldn't happen. And so I think we're looking at something like that here too, where the market is just quite strong. And there's a lot of interest in coming in when it does get lower. And so, there's some catalysts to this, and we'll talk about those. But because we've had some decent earning reports that come out, Google did a big share buyback and dividend. We
Yeah.
talked about that, and Apple had a big share buyback announcement. There's things that are really kind of driving the market on the earnings side also. But we let me switch views here so we can see this a little better. Um, the key thing that the market's really concerned about is inflation for the most part. We're not really talking about recession any longer. And we're talking about, when the Federal Reserve would be lowering rates. And so they came out and said, hey, we don't have confidence to lower, we don't see the confidence at this point to lower rates. And so we think we're going to be up longer, before we cut rates. And they did say a couple things. Number one is they don't expect to raise rates.
Yeah, that's big.
Well,
Yeah.
that's actually pretty big. Now, that doesn't mean they won't, right? I mean, but their expectation and what they're seeing, they're not expecting to raise rates because that would really shock the market, right?
Mhm.
And so that's kind of a big deal. But then they also feel that they're going to start cutting back. Right now, they've been dumping bonds off of their balance sheet that they
Yep.
purchased during the pandemic. That is a way of tightening up the money supply of the market by doing that. And they're going to cut back on that activity. So that's that's what they did before. They stopped buying and then they started tightening, the
Yeah.
rates up, right? So they're doing the same thing now. They're going to stop selling some and then eventually lower rates. So they're moving in the direction. I think, I saw that as quite positive, even though the market ended up down
Yeah, it's
after
kind of a
Q&A.
snail's pace what the compared to what the market wants.
Yeah, that's true. Markets was looking for 6 rate cuts at one point this year. That's not going to happen. Although I will say today's action. So this is the jobs report for how many open jobs, and you can see. First of all, if you saw this on a really long-term basis, going back, decades, this is an epic number of open jobs.
Yeah.
Even now. But this is the lowest we've had now since 2021. So the number of job openings is starting to come back down. And again, that sounds like bad news, but it's actually, unfortunately, in this case, good news because what's happening is there's too many open jobs. That creates, higher wage demands to kind of get those jobs filled.
Yeah, ideally you want to be 1-to-1 or
Yes.
lower than that.
Yeah.
But right now we have an excess of job openings to the actual people that want to work.
Yeah, exactly right. And it's pretty incredible, kind of what's happening there. But if you're worried about inflation and you're worried about it costing more to go out to eat or to cost more for the different things, then having this come down is a good thing because it does tend to take some of the pressure off. And then today, of course, we got the jobs report for last month. There was 234,000, I think, was the expected number of jobs, and 175 was the actual number of jobs. And you can see here over the last 12 months that that's relatively low. It's still a good number, actually.
Yeah, you're still growing.
Yes, it's not shrinking like it was during the pandemic or during other recessions. It's still growing, but it's not growing as fast. And so, again, that's just sort of a sign between the number of job openings and the number of new jobs that things slowing down a bit because the concern is inflation, right? And so if we look at, here's the core PCE, which we got, kind of this week also. This is year over year for the last year, right? And so it's hard to see this, but it's 2.82%. So what that does is means it's looking at, in this case, March of this year versus March of last year. The difference in this basket of goods was 2.8% higher. Okay, they're looking for 2%. We're pretty close. That's not too bad, right? But the problem is what we're seeing month over month. So if I look at this February versus this March,
Yeah.
yeah, or this March versus this April, for example. And so you can see what's happened here if we look at the last year, again, on month over month inflation with the same US core PCE, you can see it's up a lot here in this first quarter. And that's why the market's been kind of struggling because it was, look at how good it was
Yeah.
for the previous portion of that year. Very low to the point of zero in a couple of those months, essentially. So, however, if we take this back just one step and we go look at the last 3 years, month over month, and then you kind of get more perspective. You can see, first of all, that it does jump up quite often, even
Yeah.
though the inflation's been coming down for most of that 3 year period. You still get these spikes that come up once in a while, and that's what the Federal Reserve has been trying to say. Hey, this isn't such a big deal. This does happen, and I put a little, a trend line in there just to say, hey, you can kind of see even then, the month over month spikes are still, trending in the right direction as far as that goes. Um, so that's what's happening this week. I actually think there's a lot of positive things with the Fed, starting to ease up on their bond, sales, with the, job market kind of cooling off a little bit on both, the number of jobs created and the number of open jobs. We've got this, short-term primary direction where, we're not setting new lows. So we're at least going to get a pretty good bounce here. To truly get into a new primary direction, we need to get into a new all-time high, right? That's what, that and we keep on going. Now, on a daily or weekly basis, we're still in a primary direction that's up. I'm just talking about here just the short term, what's happened in the last, 4 or 5 weeks.
Yeah.
But good time actually. Today's is a great day too. So this is kind of a fun market to be in. I think that this rest that we've had, I would say the price that we're at now, we were at maybe 2 months ago, right? So something in that neighborhood, maybe 6 weeks ago. So at least we've had some time where the market can kind of go sideways, absorb some of these different things, because it gets to be a problem when it stretches out too far and keeps going and going. Actually, that scares me more than a lot of different things, just because what I've seen in the past, what I saw in 2000, for example, it went so far and then it starts to fall, and then it just kind of catches its own momentum and starts to really fall. And all of a sudden you're down 45%. So I'd rather have these little breaks, 5-10% breaks that come along. I think that's the healthier way to make the market. So, nothing we can do about it one way or another, but we can react to them and we can watch for them and we can hope for them.
Yeah, usually these runs, I was looking at a chart and it was showing like 18 to 20 weeks where like kind of those upward runs, and then they had some kind of consolidation period afterwards.
Yep.
And so we kind of hit that point with this one.
Yeah, exactly. And it's been, fun to watch. But things are good in my opinion. All right. Thank you.